How's it going, everybody? It's Jim. Today, I'm gonna go over 10 types of investing, how they work, and help explain them to you in the most easy and simplified way to understand. I remember when I was first getting into investing, I was just so overwhelmed with all these big words and all these terminologies that I just did not understand. It literally was like learning another language. It was like hearing a foreign language. I just wish there was a video out there like this one that would help me understand those videos at that time, but there wasn't, so that's why I'm making this one for you. So if you're new to investing and you're eager to learn, then hopefully this stuff helps you out. Don't forget to drop a like on this video if it does. It greatly helps out my channel, so it just takes 2 seconds. Make that button turn blue. Make sure you guys stick around for the entire length of this video. This way you could hear all these different strategies because some of them may be a little bit surprising to you. So number one on the list is stocks, and stocks is by far the most common strategy used for investing for a beginner. Now, when you buy a stock, it's basically like you're buying a part into the company. So say you bought Apple stock. Congratulations, you're now part owner of Apple. A very, 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 very small part of Apple, but you are. Now, the idea behind this is that you want to buy in when the prices are low and then sell when they're high. This way you get in when they're low and you have the anticipation of those companies doing really well. Their stock value goes up and then you could sell off when they're high and you make money. Bonds is next up on the list, and bonds are basically a loan given to a company or the government by the private sector. Basically, that company or that government will pay back those bonds years down the road plus interest. Investing in bonds is safer than investing in stocks, but it does have its own risk, as everything does, right? And it also pays out less. A company will issue out bonds when they're in the need of money and then later on pay it back plus a little more for you lending them your money. Now, long-term government bonds historically show about 5% return, while the stock market could sometimes show up to 10% return on average. Of course, that's before you take in consideration inflation. Now, there's 2 main things you gotta learn here: maturity date, which is how long you have the bond for, and the coupon rate, which is how much you earn every single year. For example, a $10,000 bond with a 10-year maturity date and a 5% coupon rate will basically pay you $500 every year for 10 years. And at the end of those 10 years, you're gonna get your $10,000 back, the initial principal that you put in, which means you would earn about $5,000 in total over that 10-year period of time. Next on the list is mutual funds. Mutual funds will take a bunch of money from a bunch of different people, usually in the thousands, and they'll pull it all together and then be managed to invest that chunk of money into different sectors of the stock market in different categories. This way it helps diversify your portfolio a little bit and you're not putting all your eggs in one basket. So if you think about it, if you had $1,000 to invest, you could only do so much with that money. But if you got 1,000 other people on board with $1,000 each, that's about $1 million. So an investor could then take that, split it up into a bunch of different sectors, and now you get to benefit from the gains from all those different sectors instead of just only a little bit here and a little bit there because you're limited with only $1,000. Some things are gonna go up and some things are gonna go down. So if you have a little bit in each one across a bunch of different sectors, it's more likely to balance out more nicely and more evenly. Exchange traded funds, also known as ETFs. It's a type of investment that involves a collection of different stocks, so it's kind of similar to the mutual fund. However, ETFs trade throughout the day, which means their price is constantly fluctuating up and down, whereas the mutual funds is just your overall net value of your investment. Now, ETFs can include all different types of investment strategies like stocks, bonds, or commodities. This is another great way to diversify your portfolio and not put all your money into one thing. So for example, if you had $1,000 and you invested it all into Apple, you're banking on Apple going up. If it goes down, you're gonna lose all your money. Versus if you bought an ETF that covers a whole bunch of different sectors, like in the technology sector, then you have a better shot of it balancing out and being more even over time. Now, ETFs are my personal favorite way of investing because it's more of a passive way to invest. You don't necessarily have to be on top of it, watching it every single day to do well in it if you don't want to. So the way I look at it is it's more passive, it's more of a buy and hold long-term thing, whereas stocks, you're gonna wanna keep on top of that and check it every single day because you don't wanna miss your opportunity to sell. Certificates of deposits, also known as a CD, is a very simplified, very good beginner stage of investing. It's very simple to do. It's just giving your bank your money for a certain period of time. Now, when that time period has ended, you get all the money back that you gave them originally, plus the interest that you earned on it. The longer the bank holds your money, the more interest you're going to make. Now, the only downside to this is that once you put your money in, you cannot touch that without getting penalized. So say you signed up for a 2-year CD and you put $1,000 into it. You cannot touch that $1,000 until after 2 years. But if you wanted to pull it out early because you needed the money or something, then you would get penalized and have fees taken out of it. Now, this is probably the lowest forms of returns in the investing world. However, if you're new to it and you're just new to this whole process, it's a great way to get warmed up by opening up a CD because it gets you in the habit of taking money, putting it aside, and not touching it. And that is the key to successful long-term growth in the investment world, is to buy it and hold for the long term. So a CD is a great way to break you into that. But again, I wouldn't put all your money just into a CD, because if for whatever happens you need your money, you're not gonna be able to take it out without getting penalized. I personally had a CD when I was a teenager for a while, but I haven't invested in one since. It's just not enough return for me, and I'd rather be more focused on the markets. But that's just my opinion. Options is another great way to invest, and probably the most confusing one and hard to understand when you're first starting to learn about it. So with that said, I'm going to do my best to give you a short explanation and definition. However, in the near future, I'm going to be releasing a video all about options. So definitely subscribe and put the bell notifications on. This way you don't miss when I post that. But simply put, the option is basically a contract which allows the buyer the option to buy the stock at a certain price within a certain time frame. Here's a quick example, fake scenario, just made it up. Tesla stock right now is at $1,000. Now I want to be able to buy Tesla stock, but I can't do it right now because I don't have the money. But in 2 months from now, I want to buy Tesla stock, but I have a feeling that Tesla stock is going to go up to $2,000, and I don't want to pay $2,000 for it. I want to pay $1,000 for it. So I'm going to buy what we call the option. This will allow me to buy Tesla stock for $1,000. It will lock me into that price no matter how much the stock is in 2 months. Now I pay for this option. So for simple math, let's just say it's $100, which in the real world, it's nowhere near that much, but just for simplicity's sake. So I pay the seller of this option $100 to lock me in at a price for Tesla at $1,000. Now I'm anticipating that Tesla stock is gonna go up to $2,000. Fast forward 2 months, Tesla stock is now $2,000, but because I was locked in at a price, I'm able to buy that $2,000 stock for only $1,000. Then subtract the $100 I paid to lock me in at the price, I just made an instant return of $900. Now let's say Tesla stock did not go up to $2,000 and it actually went down to $300. I now have a choice here, which is why we call it the option, right? I have the option. I could either buy the stock that's worth $300, but because I paid to lock myself in at a price, I have to pay $1,000 for the stock that's only worth $300. Or I can choose to not buy the stock at all and walk away losing $100 to the contract. Annuities are another easy way to invest. Annuities are basically a contract between you and an insurance company where you pay them a lump sum up front, and then they continuously make you payments over time. Now, people mainly use this as a stream of income for once they're retired, right? They'll save up a bunch of money, give it to an insurance company. In return, they're gonna make payments through you periodically for, however long you want it to be, I guess. And since you gave them this money up front, they are going to be giving you back more than what you gave them initially, so you earn interest on that. Now, this is taxed as regular income tax, not capital gains tax, which tends to be a little bit lower. Cryptocurrencies are relatively new to the investing world. Now, when you hear cryptocurrencies, you probably automatically think Bitcoin, right? Cryptocurrencies are a little bit different, kind of confusing sometimes, but basically what they are is a digital currency with no government backing, which means they don't belong to anybody. They're just kind of in the air, And you could buy and sell these through any cryptocurrency exchanges online. It's pretty simple. And some retailers actually will accept those as payments. So it's kind of like it's an online currency that's starting to pick up in the world. Now, these do have wild fluctuations, which means they're constantly going up and down and up and down. There's no way to predict it or kind of figure out which one's gonna hit when. And that is what makes these a very risky investment. The only thing that I don't like about this is they're not backed by any federal government, which is kind of a little bit uneasy with me. I feel like one day they could just disappear and then poof, your money's gone. Now, commodities are physical products that you typically buy, like fruits, vegetables, any energy products like oil, coal, solar power, and also precious metals like silver and gold. Now, commodities can be very good at certain times. However, they themselves have a lot of risk too, as they often can fluctuate. For instance, in some cases when there's political things going on, it could easily alter the change of prices in oil, and that makes, obviously, the oil price will go up or down. But the agricultural side of this can also be impacted, like the fruits and vegetables. If we have bad weather one year, if we have a huge drought and nothing can grow, or one of those viruses comes along, those airborne viruses that like kill the plants and everything like that, those are factors which will impact the prices of the agricultural market. So commodities can be really good sometimes, but I think they have their time and their place, and these are something you really have to be monitoring, not just how your commodity stock is doing, but what's going on in the world that's going to change the price. what's gonna happen that's gonna make the price of oil go up or down. Whereas say ETFs can sometimes be more passive, where you just kind of buy it and hold on to it and move on with your day. So the bottom line here, guys, is there's a lot of different ways to invest your money. Some of these are perfect for beginners, and some of these require a little more experience, and it's not that it's too hard to do and too hard to understand. It just takes a little more time to get familiar with the investing language and the terminology, because really at first, it is like learning a new language. I'm 24 years old, and I first started building my investment portfolio when I was 22. Now, I personally really like ETFs because it's more diverse, it covers a lot more sectors, and for the way I like to invest, it's a lot more passive. Meaning I don't constantly have to stay on top of it and constantly check it every single day if I don't want to. I just check in on it here and there, see how things are going, and make changes as need be. But overall, mostly it's to buy and hold for the long term and have that slow, steady growth. I also do have some individual stocks, some commodities, and also have a Roth IRA retirement fund set up. So now that you know what I'm into, I want to hear from you guys. What are the sort of things that you find interesting? Are you investing in stocks, bonds, commodities? What are they? Let me know in the comments below. I do read and respond to just about every single one of them, and I really do appreciate your feedback. Now, if you guys are new to investing and want to learn more about this, then definitely hit the little red rectangle down here in the corner and subscribe. This way I can keep you guys up to date with more information. And don't forget to put the bell notifications on. This way you don't miss out when I post new videos. I've been on YouTube for just 2.5 short months at the time of me making this video, and I gotta say, guys, I'm loving the support you guys are giving me. I really appreciate it, and the truth is, without you guys showing your support, I can't do what I do. So I thank you. On my channel, I cover everything to do with finance, investing, entrepreneurship. So if you're looking to build your own business, start a little side hustle here, or make some passive income over there, then you're in the right place, guys. I got your back. So if you're interested in that kind of stuff, guys, then stick around, hit the little red rectangle one more time if you forgot to already, and don't forget to smash the like button for the YouTube algorithm, as it greatly helps out my channel. Thanks for watching, guys. I'm Jim Leadus, and I'll see you on the next one.